Welcome everyone. Thank you for joining us. We wish everyone well and that everyone's staying safe and healthy. My name is Chris Ferranti. I'm a partner in Sherman's Real Estate Group. I'm really pleased to be hosting this webinar, Real Estate Investing in a Pre- and Post-COVID World. We have planned a thorough and in-depth discussion on family office real estate investment trends. Before we get into this webinar, what I'd like to do is briefly provide a few notes about the webinar and the webinar series. So first, this webinar is being recorded. Replay will be posted on Sherman.com and on our social media channels through LinkedIn and Twitter. If anyone has any questions, please hold them until the end. All questions will be addressed during a Q&A segment and can be submitted through the Q&A chat at the bottom of your screens. So why is Sherman hosting these webinars? In response to the pandemic, we launched a series of webinars with programming aimed at promoting engagement, education, and investment sharing opportunities to our family office and private clients and contacts. We hope you join us again for our next webinar. Information on that webinar will be given at the end and will also be made available on our website and social media channels. So please look out for that. As I mentioned, I'm a partner in Sherman's Real Estate Group. I'm also a member of Sherman's Family Office Group. I work with a number of family offices and assist them with their real estate transactions. The Family Office Group includes a team of attorneys across various practice areas that support our family office clients. The team is very experienced in advising single and multifamily offices, private clients, and family enterprises as they navigate investment decisions, estate and tax planning, charitable giving, multi-generational matters, and all other areas of particular interest to family offices. I know this topic on real estate trends is of great interest at this time to many family offices. Family offices typically invest a sizable portion of their entire investment portfolios in real estate. And pre-pandemic, the portfolio allocation to this asset by family offices, generally speaking, seem to be steadily increasing. More than other types of investors, family office investors devote significant time keeping up to date on the investment plans and activities of other family office investors, even though no two family offices are alike. They're a relatively unique group with similar long-term investment goals. So being aware of what this group as a whole is doing is a valuable data point for family offices and professionals that serve them. So it is with great pleasure that I introduce our guest speaker, DJ Van Kuren. There is no one better qualified to inform us on this topic. DJ has more than 25 years experience in the family office, real estate, finance, investment banking, and fund management space. Prior to co-founding Evergreen Property Partners, he was president of real estate for the Montfort Companies, a private single-family office. Before that, a vice president of real estate for the Heyman Family Office. He was a director of the Arsenal Family Office, a managing director for the Jane Family Office, and a managing director of the American Dream Fund. He was one of Family Capital's top 10 family office real estate professionals and one of Trusted Insight's top 30 family office real estate investors. He's also a member of the Forbes Real Estate Council, author of Real Estate Investing for Family Offices, founder of the Family Office Real Estate Institute, the Family Office Real Estate Magazine, and he's a frequent speaker at family office conferences around the world. So DJ, welcome. We're excited to have you join us. The questions I plan to ask will take us through the experience of the family office real estate investor immediately before and then during the pandemic. And we will discuss how events have since unfolded and may have shaped and changed real estate investment decisions in the future. So let's quickly flash back to January 1st of this year. Or you can even go to February. I don't think your answer is going to differ that much, but essentially taking us to the point, immediately before the pandemic hits the U.S. What are some of the trends we were seeing And let's start with maybe the types of real estate assets family offices were investing in.
Yeah, Chris, thanks for having me. Feel very fortunate and humbled to be on your show. So thanks so much. Yeah, it's the landscape has definitely changed, just like for many people, many industries across the board, pre-COVID, post-COVID. Families had really started to increase their allocations over the last couple of years into real estate. Really started to get in closer to the high teens, low 20s from an allocation of real estate out of their total portfolio. And the main investment of choice was multifamily, hands down. Families were very, very interested in multifamily. That was their number one choice. And that goes back into 2019 as well, where multifamily investing was the number one. And then behind that was actually office and then land and industrial. Now it was in 2019, right? Now going into 2020, once again, multifamily was number one. In fact, 75% of families, they wanted an allocation in that area. But what's interesting is that, office fell back going into 2020, and it was actually over 50% wanted to go into industrial, which has proved to be a great place to be even into the COVID environment.
Got it. And DJ, what about geographic markets? Maybe what parts of the U.S. were family offices investing in primary, secondary, and tertiary markets?
Yeah, and one of the areas too that we gather our data from, you'd mentioned family office real estate. We put out the largest real estate study of its kind on family offices and real estate investing, actually on a global basis. So we've been able to generate some really good statistics and information. When you look at family offices from an international perspective, they all want to go to the primary cities, right? The ones that have ports. That's the San Franciscos, the LAs, the New York, the Miamis. And, however, with family offices in the U.S., the majority of focus is in secondary markets. So you're looking at the Denvers, the Salt Lake Cities, Austin, right? Charlotte, Nashville's up and coming, Boise's up and coming. And so they're much more apt here in the States to go in those secondary markets. And then you've got the tertiary markets where they're open to as well. Now, what's great about that for families is that the institutions, just like the foreign families, they want the large major markets as well. Once again, the New Yorks, the San Franciscos, the LAs. A lot of that has to do with the actual amount of money that they're investing, right? Where the families are typically going to invest less. Of course, I do want to say is that the larger families, the Michael Dells, the Bloombergs of the world, they're going to write a minimum check of probably $20 million. So once again, they'll look for more of the trophy assets. But as a whole, the majority of family offices, and these are also families that didn't necessarily create their wealth in real estate, secondary markets, they're great. And there's a huge advantage there that the families are willing to take or that they have actually, because their property size is under the institutional level. And there's greater growth opportunities in these secondary and tertiary markets.
Got it. Yeah, you had mentioned on allocation, and that was steadily increasing into the teens. How does that break down in terms of direct investments through either directly acquiring the asset or through joint venture structures or co-invest versus through funds or public REITs?
Yeah, so direct investment has been a trend for quite a number of years now, right? And you read even a lot about that today in private equity and whatnot. But direct investments is the primary area that families want to be. In fact, probably about 80% of the investments are wanting to be into direct, and that comes because they have more visibility, right? There's a concern about fees. There's a concern about what's really happening. And although it doesn't necessarily give you that diversification as a fund would, it still provides additional insight. Now, direct, just to be clear on that, a lot of people think that that's them just investing directly into their own properties where they own 100%, which, yes, that is part of direct investing, but it's also direct investing when you're investing directly with a sponsor or an operator, right? So think of it as direct investment, just strictly on a one asset investment perspective. When you look behind that, there's definitely a huge interest, which falls into the co-investment with other families. Families love to invest together, as you know. And that is for a number of reasons. One, they might be able to piggyback off the expertise of another family, but also it's there's a comfort there investing next to other people that have the same philosophy. Right now, we're doing some work with a major hospitality family, and their strategy for the first time in 90 plus years is to allow other families to invest next to them, and that whole driver is because the mindset, right? A longer term mindset where they can create generational wealth and legacy wealth, and there's a difference there between the people that just want to get out and maybe just buy and basically the fix and flip type model, even if it's on the commercial property side. And that behind that is our club deals, which is once again just coming together. What's interesting is that you'd brought up about REITs, and then you look from a fund perspective. A very small amount of families actually go into public REITs, probably just under 10% that will put some money in there. But what's interesting is that where you see an increase in REIT investing is actually through the foundations. The foundations will take more of a approach using REITs, for example, than private family offices. The private or the foundations still want to go direct, but once again, they're still open. And I think a lot of that has to do with the mentality, right, of the foundation, making sure there's money for future aspects that they want to invest into. Chris, the other thing that I will mention that's not a surprise to me, but is people don't realize, you hear about crowdfunding over the years, and it's definitely increased significantly in the market as an investment option for investors, but no family offices participate in crowdfunding. And that's primarily due to the importance of relationship.
DJ, would you say family offices were gearing up for an eventual downturn? I mean, the economic expansion pre-pandemic was getting a bit long in the tooth. Were family offices prepared for a period of distress like this?
For what we're coming into? For years now, they've talked about, a lot of families said, okay, we believe that we're going to be seeing a downturn coming around the road, right? Not sure when, but with that being said, from 19 to 20, they actually increased their allocation into real estate. What's different this time, a lot of families, when you look back into the Great Recession, 08, 09, families were sitting on the sidelines, waiting until things started to get going. So they still benefited from that, but not to the degree of if they came in sooner. It's a little different this time. That memory has not gone by the wayside. And so families now are actually, they're mentally ready for it. They know there's a downturn, right? You can see it, and they're not afraid to necessarily do that. Now, when you look at something like hospitality, they're like, okay, well, when is the bottom going to hit? The problem that's different with what's happening today is that it's based upon, that black swan. And, if we get some type of something to take care of the COVID, right, issue that we have, then things could turn around immediately. But with that being said, families are ready and have been starting to invest into the opportunities that present itself. And right now it's primarily hospitality, retail, and you've got a lot of debt that's coming up and will be coming up as well.
So let's fast forward a bit to the point, COVID hits the U.S. We're now in a pandemic state. What were some of the immediate actions that were being taken by family offices?
Well, the first thing that families were doing was they put the brakes on the real estate. We had a number of projects we were working with a major family on, and we were oversubscribed 200%, and it went down to where we ended up with 10% or something like that. Ridiculous. So everybody put the brakes on, and they actually ended up focusing into the securities, their public securities of what they had, because there was so much volatility there. So that caused families to focus, said we got to see what's happening with our portfolio, and also where are the opportunities. So that was the first place that they all went. Now, what has happened too with families, which is actually a very, very big positive, is that a lot of families took this as an opportunity to say, okay, let's step back. Let's really look at where we've invested and what we've allocated toward. Were they good decisions? Were they not good decisions? And what should we do going forward? And did we make good investments, et cetera, from a portfolio perspective? But the first place was the equities, and it was like, that's all we're focusing on at the time.
Yeah. And so how did you see those actions sort of change and evolve over the course of the next few months?
So, obviously there's been a lot of upside in the stock market. So there's been a lot of activity that's happened there. Buying opportunities, etc. But families got their feet under them, and then they started looking, and real estate is obviously the biggest area of distress. And so they've started to come back in and really take a hard look at, where is that opportunity? What's the best way to go about it?
Yeah. And so on distressed assets,
Sure.
Are you seeing family offices begin to now focus on investing again, expecting to see some generational buying opportunities?
Yeah, by all means. And the first area has been in hospitality, but the biggest thing with hospitality is an operating business. So you can't just go out and buy these things. You got to make sure that you're with a seasoned operator, and that there's the so that they can ride it through. Now you have a lot of funds, hospitality funds, as well as people wanting to go buy, sponsors and operators that are wanting to buy. The problem is that, they have an existing balance sheet with a lot of the hospitality properties that probably aren't even performing right now. Right. And so you got to be very careful for what you're looking at for that. But yeah, that's the first place that families have been moving, and they have been writing checks and starting to take action in the area of hospitality. And they're still multifamily. People are still looking for distress, and I've got a thought on that as a whole. But they are starting to take action as they go. They're still being a little careful, but action is being taken.
And how would you compare the actions they're taking now and the positions they're in now compared to the last financial crisis? Are they better positioned than they were?
Yeah, it's once again, they have a different mindset, right? Where before it wasn't. When is the recession going to turn? Right? How bad is this really going to be? What's the Fed going to do and whatnot? This time, it's really, are we going to get a vaccine? How bad is this going to get, right? And I think a lot of people are starting to get COVID fatigue. I know I am for sure, and people are starting to get back to work. And I know quite a number of offices that are starting to get in going into the end of this month, and this could be life as normal going forward. So, the big difference here is that they're not afraid. They remember what was happening before. They want to take advantage of that opportunity, but it's much more sort of easier to see into the future than it was before, because this is really driven once again about the vaccine and what will happen with that. The fundamentals are staying the same. Denver, for example, we are seeing a huge influx of people that are coming here. I mean, it's gone up 30, 40%. And that's, quality of life, cost of living, but the jobs are going to be here. They'll continue to be here. Same thing that's happened out in New York. People are moving to the suburbs. California, San Francisco, they're moving to the suburbs, right? And a lot of New Yorkers are not only moving out of state to like Connecticut, but also down to Florida. So you have those migration patterns that are happening, which is going to boost, those opportunities in real estate. So those fundamentals make a big difference, and it's quite different than it was during the recession.
Got it. Now, what would some of the characteristics of a deal that would be needed to entice a family office to invest in a real estate deal right now? I mean, you look around, you see, some winners in this, including the biotech or telemedicine fields. Why invest in real estate as opposed to investments in those areas?
Well, there's definitely opportunities in some of the areas that you mentioned, but it goes back to the reason why you invest in real estate regardless. One, it's a tangible asset, right? It's there. It's not going anywhere. The old adage, location, location, location. If you've got a good location or you're in the path of progress, then you're only going to see, upside. Plus, the people don't ever talk really about what's your true return that you're getting in real estate. A lot of times you can invest into a real estate property and you're not paying taxes for years, right? You've got the depreciation, the amortization, you've got the cost segregation, interest deductions. I mean, you've just got so many facets that real estate can really help. Plus you can have income, that's driving off for future generations. And it's continued to prove to be one of the greatest wealth creation areas. And for families outside of where they created their wealth from the industry, real estate is the second greatest area of wealth creation.
How do you think COVID has affected demand for each of the property types? You mentioned earlier on industrial and office, and just looking into the future, do you think any of these demand trends are going to stick long term?
100%. And it goes back. I mean, you still have all of the fundamentals as to why people move to areas, right? Like a Denver, which is the cost of living, quality of life, where the jobs are. In fact, there was just a major company, I'm trying to think of which one it was, that's now moving to Denver for their head office, right? Moving into other areas. Salt Lake's seen a tremendous amount of boom, Nashville's really coming around, etc. So the trends are going to continue on. The biggest opportunities and downsides has been hospitality, for sure. And one could say that there was a lot of hotels that really shouldn't have been out there, were really old, that needed to come off the market anyway. The first hotel type that will come back is going to be your select service. That's going to be your Moxie's, your Courtyard by Marriott, your Fairfield. And they're actually operating about 40 to 50%, in some cases 60%, which is huge compared to some of the luxury hotels where it's only, 8, 9, 10%, which is that has the concierge services and the restaurants, right? Or it makes the majority of their money off of convention business. Those are going to be hit the hardest for sure. The select service is definitely going to be the first to really rebound, provide cash flow, and get going. Now, one of the things that's coming out of this as well is that you do have quite a number of firms that are looking to convert some of these hotels into multifamily, which, the ideal type of property for that is actually the ones that already have kitchens inside, right? Which is your extended stays, et cetera. So that's really the opportunity that's being created there as well. It's not only buy certain properties at a discount, but also be able to convert them into multifamily. Now we'll go into multifamily next, which you haven't seen a decrease. You talk to any of the owners, they're like, we're still at 95, 98%. Well, the question is how much of that is actually artificially inflated? we've been getting money from the government, right? And the first thing you want to do is make sure that you've got a roof over your head. So those payments are being made. However, that's about to stop. I think we're not going to see a big problem in the Class A properties because it's primarily professionals that are living there. What is going to get hammered in the next probably 3 to 6 months is going to be workforce housing. These are people that have been really utilizing the money that's been coming from the government, which we should get another payment, I believe, or after that, who knows? But these are the people that are working these retail jobs or small businesses that have just been hammered. I don't think there's going to be jobs for these people to go back to. A lot of them are not going to be. Look at all the major retailers that have just closed up. They're not coming back. So that means that all these people that were paying their rent is not going to have any money in order to do that. And also multifamily lags other commercial property types because of about 6 to 9 months. And that's because there's a process to go through when there's not a rent payment made, right? That's for a couple of months. And then they start the vacant, to try to move these people out. And so by the time that you get to the point where you're actually kicking them out and saying you can't be here anymore, that's 6 to 9 months. So I think we're going to start seeing that coming up pretty soon. And, there may be some good opportunities there now with the lower cost of loans that you can get have offset it. Fannie Freddie came and initially said like 30,000 of the borrowers don't worry about it, right? So that's helped. But I think when we start getting into some back of normalcy, I think there's going to be a problem with rent being able to be paid because of that. Industrial, once again, families that started getting into that were very fortunate. That's done very, very well and will continue to do well. You've got, if you go into, some triple net, what I call, there's a new phrase I came up with. I've got to think of it. It's not recession proof because we found that a lot of these properties aren't recession proof, right? But they're the properties that you have to have open. So the CVS's, the Walgreens, the dialysis centers, gas stations like a 7-Eleven, actually, their margins went up for gas because that came down. So those will continue to be going well. Office is a good question. Are you guys planning on going in 100%, do you think, in the future? Or do you think it's going to be some days these people, some days these other people? Have you guys talked about that at all?
Yeah, I mean, we have a plan. It's certainly very fluid. Things are changing, but I think we certainly expect to be in at some point in the near future. But I agree. I mean, generally speaking, it seems like there's a lot of institutional tenants that are looking to reduce their footprint and their square footage and a lot of their leasing space.
Yeah, and then the question is do you do like what some universities are doing, an A and a B group? So on A's come in Monday, Thursday, Wednesdays, B groups Tuesday, Thursdays, so that you're still in the office, but you still have that spacing. That's a question. I was talking to a family yesterday, and I believe with them is if a lot of these people and a lot of people are moving out of the city to the suburbs, well, that could boost the office space out in the suburbs, right? The one thing I will say that Sam Zell said just a couple months ago, he goes, I never know anybody that has managed by modem. And I thought that was, as long as you remember what a modem is that's true, and then of course you have retail, right? Opportunities, debt, CMBS will start coming due. So, I think some of them are the obvious. I think the biggest thing is what's going to happen to these major retails and these big boxes that just shut down and are done.
Right.
There's going to be a lot more space.
So how do you I agree. I mean, I think on the, in the office, there's a question of, is that trend temporary versus long-term, right? I mean, a lot of the reduction in the remote work, once there's a vaccine, once we're sort of post-pandemic, you may have a shifting back to the way things were, or maybe this remote work experiment will be successful for a lot of companies, and they'll look to the hub and spoke model, or just a reduction in total square footage, expecting that some percentage of their workforce at any given time is going to be working remotely.
Correct.
So those things are still sort of out there. It's unclear how it'll be impacted. But how do you see, sort of in terms of allocation? I mean, you mentioned earlier that family offices primarily invest or dedicate a large portion of their real estate investing to multifamily. Do you think that'll sort of be reduced and then replaced with the logistics or the other types of property types?
They do, if they are if they're opportunistic, right? Then you're definitely going to be able to. You'll have the families that are going to look at those opportunities. And in fact, from that study I was mentioning, 76% of families wanted opportunistic, right? So they're going to look for that. Then followed by value add, which is about 58% of the families wanted to go into. But, back to your question, yeah, multifamily is still the flavor of choice. That's what family offices are going to continue to look for. They like the cash flow. They like the that you're so diverse with the number of people. It's not like an office where you lose 2 tenants and then you're down to a 40% occupancy. Here, you lose 1 tenant. You might go from 95 to 94% occupancy. So that's one of the main things that they like. But it's going to continue on, and industrial definitely has and will continue to be an area of interest for families, for sure.
You mentioned the different risk profile of the assets, core plus, value add, opportunistic. Do you think there'll be a sort of realignment in terms of the types of assets family offices are now investing in? Maybe those that were more interested in core or core plus, more inclined to take a shot at value add, opportunistic assets?
Well, what's interesting is, so you've got two types of family investors. You've got the type that are saying, let's sort of get after it, right? Get those higher rates of return. That's the opportunistic and value add. And that's where the majority of family want to put their money, is opportunistic and value add. You have the other side of the coin where they just want income and they want revenue. Now, the perfect scenario, when you look at how long a family wants to hold the assets, there's contradiction, because they want to hold assets over 10 plus years, 10, 15 plus years, but yet they want opportunistic and value add, which is typically a 3 to 5 year hold. So the ideal scenario is a value add or a development deal, opportunistic deal that you can refinance out your capital in 3 to 5 years and then just hold on it long term for cash flow. Of course, that's anybody. I think, that's the ideal situation for what you want. But I don't, that's not going to necessarily change. I think that might even increase because of the opportunities that may become available because of COVID. They take a longer term perspective, right? The family office mentality is more of a, we can wait this out. It's patient capital. And that's really where you benefit on times like today, right? It's like, buy it, let it go.
Yeah. Great. I think we're heading into our Q&A segment next, but before we do, last question for you, DJ. Are you generally optimistic about real estate as an investment for family offices?
100%. 100%. I mean, I think that, that allocation that's been going up has proved to, if you look back and you look at any real estate that anybody's held, it's continued to go up in value. I think that the key is to identify first and foremost who your partner is going to be. You've got to have a sponsor that is, and you have to look at the sponsor or the operator first. What have they done in the past? How long has the team been together? How much money are they putting of their own money? The problem that you have with a lot of operators today is, in fact, I had this conversation yesterday was, they've been around for 7 years. Okay, and they've got these great returns. Well, anybody could have put money into real estate 7, 8 years ago and you're going to do well, right? What's happened during these downturns? Have you gone through any of the recessions? How did you come out of it? What type of scars do you have from what's happened in the past? What assets did you get back? So that's the first thing. Unfortunately, there are families that will look at the deal before the operator, and you really need to start with the operator. If they can't implement, then it doesn't matter what the deal's like, right? But long term, once again, yes, it's definitely a place to allocate. And with family offices looking, to secondary markets, and one of the questions that we did have was, did families start moving into secondary markets for COVID? No, they've been that way. And it really, these are entrepreneurs, right? For the most part, that had a business. And so they're willing to take those opportunities in those smaller markets, like I said, without the institutions. And as long as you invest in good markets with good operators, in the long haul, you should be in good shape.
Got it. All right, great. Let's go into the Q&A segment. I think you touched on DJ the first point. The first question we've received, which is that asking whether COVID's been the major driving force for family offices to start looking at secondary markets, and what sort of returns are they looking at? The other, so I think you've hit that one. I don't know if you want to add anything else to that question.
I'll touch on that really quick, because he did ask, starting to look at secondary markets and what sorts of returns are they looking at. If you were going back 3-4 years ago, on development deals, you should be getting 25-30% from a gross perspective. That's come down to not only high teens, low 20s, but actually 15 to 17%, 18%. It depends on the family office profile, but as a general perspective, if you're getting a 15%, families end up getting 15%, it's a home run. They're super, super happy, right? In fact, the average return that they received 2 years ago was a little over 14. Last year was 14. This year, what do they expect? 14%. And that's on average. So it's right in that area, right? I'd say 13 to 15% is what really they've been happy with. So I want to just finish up that answer.
Yeah. The next question we have is, do we see family offices doing, as we watch massive evictions across the country, retail job losses leading to tenants not being able to pay rent, and you have this divide, between the rich and middle lower class growing even bigger.
So that would be across, and I believe this is what the question was. Where can you sort of are they utilizing real estate and the impact side, right?
Right.
Which is really where you're calling opportunity zones. I mean, that's really one of the areas. And anything that has to do with in a philanthropic nature, it's starting to become more and more with families, but it's really the younger generations that are really, really driving that. When asked if a family would invest into real estate if it had, an impact, less than 5%, the majority were less than 5% of their portfolio is what they put into that. But I think that will continue to increase over time. These opportunity zones, that's what I think a lot of people thought would happen. And so that money hasn't caught up yet for that. However, I do think that, we saw an increase, which actually doubled from 2019 opportunity zone investments to what people were thinking this year for 2020. And so that's doubled. It's still pretty low. It's still around the 18% of the families would do that. I think we're going to see a big increase in opportunity zone investments going into next year for 2022. And that's going to be driven by a lot of these portfolios where money were taken off the table by maybe stocks that they had been holding long term, creating a lot of capital gains. And so I think, and the rules are finally finalized, which is taken forever. So I think we're going to see quite an increase in that going forward into next year. And working, I'll be honest with you, I definitely, you have to look at the deal itself, but diving into some work, for example, that Jim Sorensen's been doing, and really how that's infected over the last couple of days, I'm like, wow, if you get the right project in some of these OZ zones, it truly will make a difference.
Great. Next question we got is on blockchain, and more specifically on tokenization, and how we see that impacting family office real estate investing in the future. Do you think the pandemic and the acceleration of trends has helped or hurt tokenization?
First off, I think that what people don't realize is that the impact that blockchain is going to have actually on real estate, and not just real estate, but a lot of industries, including yours, within your industry as well. The U.S. is well behind other countries for sure. But that type of technology is going to truly impact every part of the real estate, from contracts to how the legal aspect is handled to the finance, right? It's going to streamline everything. COVID isn't going to have any impact necessarily on that. I don't think so. I mean, especially because we're still in many regards in our infancy stage. But in the future, if we continue to have a problem where I don't personally think this is a black swan event, I think that this is going to be sort of part of life going forward in some ways, unfortunately. And as blockchain can help streamline all the parties that are involved, not only will it speed up the time, but you're not going to have as much interaction as what you've had in where each party is touching a part of it, the whole process, right? And so I think that's definitely going to be that'll be a benefit from a long-term perspective. Just like I think Zoom's is going to make a significant impact. I always wondered, why aren't people Skyping? Why aren't people having these face-to-face? Well, either they didn't have cameras or just why, right? Let's just have a phone call, where now I think this will be the norm, and this will impact every part of the business. So I think there'll be a greater impact from Zoom than there will be blockchain, at least in the short term.
Great. Very good. I think that's all the questions we have on the Q&A.
One question I'd like to ask you: have you seen an increase in your practice, as in transactions, or what's happening with families in their real estate?
Yeah, I mean, I think my experience is similar to what you described. When COVID first hit, there was a lot of securing portfolios, making sure that issues are addressed, and a hesitancy to sort of jump in, because we still hadn't gotten our arms around the issue, and the genesis behind this financial crisis being a lot different than the last, and waiting for the markets to sort of stabilize. Fast forward a few months later, I think for the most part, family offices are in a much better position than they were during the last financial crisis, for the same reasons you described. A lot of them sort of learned from the last financial crisis. They built teams. They're more savvy when it comes to real estate investing generally. And they want to jump on those generational buying opportunities that maybe they missed out on during the last financial crisis. So our experience is that Family offices are engaged. They're looking for opportunities right now, and activity has been steadily increasing in the last, I'd say, month or so, because they're really looking out for opportunities that it's no secret. A lot of private equity firms during the last financial crisis did pretty well in the real estate market, because they jumped in, bought a lot of the distressed assets, and over the last 10 years or so, did pretty well with those investments. And I think family offices want to not miss out on that opportunity this time around.
So do you think, so from a family office perspective and in the real estate portfolio, right, or real estate portfolio in general, is there anything that you would suggest is there anything that you would add in addition to some of the planning that you're already doing, or that you think, okay, now after we've gone through this COVID, you're like, oh, wow, we need to make sure that this is sort of buttoned up in case this happens, or you really need to do this type of planning or that type of planning in order for, to insulate yourself from this possibly happen again?
Yeah, I mean, I think there's certainly going to be some things that we'll learn from this time around. Similar to the last financial crisis, I think there was a lot of learning that was done, and so they built teams. A lot of family offices that maybe didn't have somebody that specialized in real estate brought somebody onto their teams that did, and we're certainly going to learn from this as well. I think one of the main things we are discovering is how critical for the direct investment side, which you mentioned, which could include a joint venture structure where you have an operator who runs day to day, being very selective in terms of who those joint venture partners are. I think family offices, generally speaking, are very selective. They want to partner up with a JV partner that they can trust, that they want, obviously, JV documents that protect them, but they want a trusted relationship so that during times like this, that they're not having to raise claims and that sort of thing, and that they can just work together during times of distress and see the portfolio through it. And so I think if anything, there's a new experience learned with those JV partners that they had selected. A lot of them are finding out how good those relationships are now. And so I think you might see sort of a shifting in terms of the diligence that's done on those operators going forward.
Imagine that you're also probably, were you guys putting in any legal language around an event like this in the past? I mean, I would think that that's going to start being a normal risk disclosure.
That's right. I mean, I think for the most part, all the documents did not include anything that specifically addressed this event. Arguably, a lot of the force majeure clauses sort of captured it through, depending on how it was drafted, but not a lot of them specifically mentioned pandemic. And so when you sort of look at the landscape of legal documents, from JV documents to loan documents to even leases with tenants, a lot of them were just devoid of how do you handle this? How do you allocate that risk and deal with the cost of it? And so we're dealing with that now, for sure. I mean, as we do new deals, we are trying to figure it out. I think the big issue is how to allocate that risk. I think a lot of the big events, you have an insurance product, and unfortunately, what we found out is a lot of the insurance products out there specifically exclude pandemics. And so unless you have something like TRIA that exists for terrorism risk that the federal government puts in place to allow insurance companies to have reinsurance to provide that sort of risk in their coverage, there's going to have to be, as between the various parties of these documents, some sort of allocation of that risk, which is just such an unknown, and as we're seeing, so costly and expensive.
So do you think that there'll be like a new insurance vehicle or an addition, like a rider that will help protect some of this stuff?
There are discussions on it. And again, there's discussions right now of having something like you have with terrorism, the Terrorism Risk Insurance Act, where it allows insurance companies to provide that coverage because they have a backstop with the federal government. And so there are discussions on that now to include something like that, called PRIA, Pandemic Risk Insurance Act. But those are just discussions. I mean, nothing's been certainly been finalized yet. But that might be the solution that's needed in order to have that insurance product out there, so that the parties don't have to try to allocate this type of risk.
Do you think that that there'll be a way to, as an operator, with some of these lenders, if something happens like this again, that can help protect some of that? I mean, or do you just have to rely on what's happened this time, where there was a lot of insurance companies that were not insurance lenders that were like, okay, we're going to ease this for you?
Well, I don't see lenders generally allowing to sort of reduce, mitigate, or provide that sort of forbearance in advance of that event happening. And equally, I don't really see, unless in the lease side, because I guess this is a whole domino effect, right? Rents are paid, the owner then pays its debt service, and then the lenders pay its co-lenders or whoever's behind it. And I think in terms of that domino effect, you're going to be hard pressed to see landlords agree to tenants that they'll in advance agree to rent abatement, unless there's significant leverage. The landlords, maybe an office building context, you have a huge vacancy, or the tenant is renting a large amount of square footage. And I don't see the lenders doing it. So I think there's going to need to be some sort of product that's put in place. Otherwise, you unfortunately have tenants bearing that risk, but ultimately the landlords and owners bearing that risk, because there's nothing they can do if tenants ultimately just don't have the cash flow to make do on rent.
Chris, I got one last thing to say, which I just thought about. Single family homes there's going to be a huge market and availability, primarily because I think it was Wells, Citi, and Bank of America maybe, that they were allowing you to defer your mortgage payments. But what they were making you do, that if you deferred it for 3 months, and let's say your payment was $2,000 a month, at the end of that third month, you got to pay the full amount. It wasn't like we're going to start again in month 4. And if people can't make that $2,000 a month payment now, there's no way they're going to be able to write a check for $6,000. So I think you're going to see a lot of opportunities coming into that single family housing market because of that.
Yeah, that's a good point.
So
great. Well, thank you. Thanks, DJ. And thank you everyone for joining. We wish everyone watching well during these difficult times. We hope you and your families are all staying safe and healthy. The next installment of our Shearman and Sterling Family Office webinar series, which is titled Family Offices and Investing for Impact, will take place on Thursday, September 17th at 11 a.m. Eastern, with City Light Capital Partners Josh Cohen and Tom Bruce, and it will be moderated by Shearman and Sterling Capital Markets partner Chris Forrester. So we look forward to seeing you again.
Chris, I just want to thank you very much for being on the show. I can't speak highly enough about yourself, the help you've done for us and your firm as a whole. And, can't recommend you guys highly enough. And thank you for, even allowing me to be a part of this as well.
Great. Thank you, DJ. Thank you. I appreciate that.